Now, if you've been keeping an eye on the stock market or even scrolling through some of the news, you've probably seen a flood of headlines screaming about a market crash. Some are even throwing around the big R word, recession. Now, there's many reasons for this market decline which has been widely covered on YouTube, but ultimately there's been a few political changes which have impacted investors' behaviour and the market sentiment. Now, before you panic and think about selling some of your investments, we're going to cover some interesting data here which will cut through all the noise and hopefully give you a slightly different perspective. Firstly, let's cover market corrections versus market crashes. Now, before we start, anytime the market declines, media and news outlets jump on the opportunity for a click-worthy story. Now, these news stories don't always make it that easy to understand what's happening. A lot of the news outlets use the word crash and correction interchangeably, so we need to understand what the clear difference is. A correction is commonly accepted as the definition of a drop of more than 10% but less than 20%. However, a crash, on the other hand, is a decline of 20% or more. And anything less than 10% can be considered a dip or a pullback. The difference comes down to a matter of degree. So when you're wondering what's happening to the stock market, ask yourself, how deep is this decline? Using this on the current markets, the FTSE All-World market has experienced quite a sharp 7% decline from its all-time highs in February. And the S&P 500 fell slightly more, dipping into the correction territory before rebounding at the back of this week. But as you can see from this data, it only briefly tipped below the 10% mark. So the word crash doesn't even come into it. It's been a pullback or correction at the most. Now that we've clarified what these phrases mean, it's time to delve into the nitty-gritty. A market crash is typically the most detrimental to your investments, so let's start there. Contrary to many people's beliefs, market crashes don't even follow any particular pattern. Since 1950, the S&P 500 index has declined by 20% or more on 13 different occasions. The average stock market price decline is 32.73%, and the average length of one of these market crashes is 338 days. What's interesting about this data is that at present, people seem to be panicking over a 10% decline, which has lasted around 6 weeks. So it's way below this average. You can see here that some of these crashes have lasted the best part of 2 years, but equally, some have lasted just 33 days. The main point I'm trying to get to here is that crashes aren't uncommon. Now, the interesting thing that this data doesn't show is typically what happens after a market crash. I came across this really interesting graphic which illustrates this really well. It compares the size of orange shade regions, which show the bear markets, and the size of blue shaded areas which represent market recoveries. The market recoveries dwarf the crashes both in terms of severity and duration. So what does this tell us? We can see that the average bull market period lasted 8.9 years with an average cumulative total return of 468%, whereas the average bear market period lasted just 1.4 years with an average cumulative loss of 41%. When you zoom out like this, you can see that these sharp falls are really quite short, and what follows is typically great for investors. The bull markets or growth periods tend to last much longer than the bear markets or declines. Now, personally, I think this data shows what a great opportunity this could be for investors. You can take advantage of these market dips to buy your stocks at a discount, with the hope of quite a steep rebound in which you can profit on. This leads me nicely on the change in perspective. Instead of seeing that market drop as something you should fear, instead you should view it like a sale. Think about it like this. Imagine you've been eyeing up a new pair of trainers for weeks. You're ready to buy them at full price, but then out of nowhere there's a huge sale, and they're now 20% off. Most people would jump at a chance to grab them at a discount, right? But when the stock market drops, people do the exact opposite. They hesitate, panic, and wait for prices to go back up before buying. It doesn't really make any sense. If you're investing for the long term, then you should view a bear market as a time that you should be buying even more, rather than running for the exit. Historically, every market decline has been followed by a recovery, and smart investors who buy at the bottom of the dip generally profit more when it comes out the other side. So with that in mind, how do we prepare for the next correction or crash? Since we know that crashes and corrections are inevitable, the best thing you can do is plan ahead. Firstly, I'd consider building a war chest. This means setting aside cash specifically for investing during market downturns. When the market drops, instead of panicking, you'll have funds ready to deploy and buy assets at a discount. This allows you to profit when the market inevitably rebounds. The second strategy is where dollar cost averaging comes into play. Rather than always trying to time the market with your investing, consistently investing a set amount at regular intervals, whether the market is up or down, is a great approach. This strategy reduces risk and takes advantage of lower prices when the correction happens. This will help you smooth out market fluctuations over time and bring your average cost ratio down. I can appreciate how daunting this could be if you're new into investing, but people who've been doing this for a few years know this is all part of the game, and it's something we almost welcome so that we can buy at a discount. The market has always gone through ups and downs, but ultimately it always recovers and grows over the long term. Again, if you're new to investing, you should be looking at between a 5 and 10 year projection or even longer for your money to compound. Investing for that longer period of time means that you can ride out any market ups and downs and ultimately profit from long-term growth. The key here really is, if in doubt, zoom out. If we go back to our example of looking at the S&P 500 over the last couple of months, sure, it doesn't look great. But if we zoom out over the longer period of time, these little corrections are almost invisible in the grand scheme of things. I hope this video has given you enough data to potentially settle some of those nerves. If you found this video helpful, drop a comment below and let me know. If you haven't already, please do hit that subscribe button, it really helps the channel. Thanks for watching, and I'll see you in the next one.